Today, we look at whether you can build your own portfolio to track your very own custom index, or simply replicate an ETF. By now, you must have heard of the benefits of an index fund or ETFs. If not, make sure to check out my video where I explain what they are and why they are much loved. ETFs and index funds are sometimes not available outside their domestic countries. For example, if you've watched my Vanguard review, you may remember how I mentioned the Vanguard Technology ETF, ticker symbol VGT, is available in the US but not in the UK. Similarly, other ETFs such as the actively managed ARK Innovation ETFs are not available in the UK either. And previously, there's not much you could do about it. But these days, you can simply build one yourself, as never before has it been so easy to invest in a large number of companies for free. You can even make your own index fund. For example, instead of buying Invesco's QQQ tracking the Nasdaq 100, maybe you might want to make your own Nasdaq 50 index fund. Obviously, this is just an example, and you should understand the risk of concentration versus diversification. One of the reasons why it's possible to make your own index fund is because previously you would get charged a commission/transaction fee every time you'd place a trade, but not anymore, as there have been a few disruptors in the investment platform space. These days, with platforms like eToro, Trading 212 or Robinhood, it costs you next to nothing to invest, and at the comfort of your fingertips on an iPad, probably in your bed. For example, in my eToro review, we saw how you don't have to pay any dealing fees, any account management fees, and no fund management fees. Therefore, by not incurring these fees at all, replicating your own ETF or index fund can actually save you money, anywhere between 1 to 2% if you're with an expensive platform provider and you invest in expensive ETFs. And what makes replicating fund possible is fractional investing. This means you can part buy a share rather than having to buy in whole units only. So whether you're looking to make your own custom index fund or replicate an existing fund, this is all possible thanks to the zero cost and fractional investing. A few decades ago, the average person could not invest in shares without calling their stockbroker and sending them a written order while checking the stock prices on the newspaper. And now you can make your own index fund and complex portfolio allocation all by yourself. Let's pause a moment to appreciate the significance of how far we've come. But it's not all rosy. With a DIY index fund, you still have to work out your portfolio allocation to match the index or fund you're tracking. And that takes away some of the passive/lazy nature of index fund investing. You also need to rebalance your portfolio on a regular basis. So DIY index funds are not recommended if you enjoy the minimal effort passive style of investing. Indeed, for some ETFs it simply isn't worth the hassle, like the S&P 500, which has such a low expense ratio and over 500 stocks, it's simply not worth it. For others, however, particularly actively managed ETFs, replication means you can boost your returns by up to 1 to 2%, which over long periods of time makes a huge difference. If you're interested in how to make your own index fund, here's 4 steps you need. Step 1. First of all, you need to work out your portfolio composition, that is, how much weight you want to have against each stock. So let's say you want to track the Nasdaq 50, meaning the top 50 Nasdaq shares, by market cap. Therefore, you need the list of the top 50 shares as well as their respective market capitalization. One of the sites I found quite useful for this is Berkshire.com. Link is in the description below. From there, you can work out the percentage weight in each stock. Also, existing funds usually publish their holdings on a regular basis, so if you're trying to replicate those, you may want to keep up to date with their portfolio allocation or simply track their underlying index. Whatever it is that you like, your next step is figuring out how to split your budget across those holdings. That's step 2. So for step 2, you can simply use a spreadsheet to work out how much money you need to put against each holding. And if you're working with a rather small budget, this can turn out to be a fraction of a share, which is fine as long as your investment platform allows for it. Do bear in mind though that there might be a minimum investment amount required for each share. For example, on eToro, your minimum is $50 per trade. So fractional investing is allowed, but subject to the minimum. Now step 3. Now here comes the part where you actually buy the stocks. To be honest, this can be a tedious process and works better if you plan on tracking, say, less than 100 stocks. As you know, the more stocks you have, the more diversified your portfolio is, but at some point, more stocks don't reduce your risk by much. If you're trying to replicate a large index or index fund, they probably aren't worth the hassle, as you probably don't want to place 1,000 orders manually, and as mentioned earlier, their fund management costs in general are very low anyway. So not much savings there, but for an ETF with a high expense ratio, that's a different story. Now step number 4. Once you've placed your orders, that's the hard part done. All you need to do now is rebalance your portfolio regularly, for example every 3 to 6 months. So there you have it, 4 steps to building your own index fund. Okay, I'll admit it does take some elbow grease to start off, but the reward is that you are now fully in control and you can save some money. As you know from this channel, my video would not be complete without me doing what I preach. So last week I built my own portfolio to track around 70 growth stocks, and so far it's been doing quite well, better than Invesco's QQQ ETF. This ETF, which I used to invest in previously, tracks the Nasdaq 100. It's been well accepted that passive index funds outperform the majority of actively managed funds, but some of them still beat the market. And there is none more famous investor than Warren Buffett to prove this point. In that case, you wonder, is it really better to invest in passive index funds? I'll answer this in a future video, so make sure you subscribe and enable the notification bell so that you don't miss it. Thank you for watching.